Welcome to the first webinar. My name is Daniel Grioli. I'm a strategist with Foresight Analytics and also the manager of a small US long-only hedge fund strategy. And with me today is Shane Lee. He is the strategist who focuses on asset allocation and portfolio construction for Foresight Analytics. Shane will tell you a little bit more about his background before we start today's presentation. Before we get into that, a little bit about how the session is going to run today. So I'll deliver some housekeeping comments, which is what I'm doing now, a brief intro into the session. After we have a brief poll. So we have two polling questions, which we'd like to put to you, our audience, relating to today's content, but also some other things that we might like to do in the future. So we'll run that poll very shortly. In terms of Shane's comments, Shane's going to talk for about 30 to 35 minutes. I'll ask some questions on the way through. If you would like to ask questions, please write them down in the Q&A box. I will see them and I'll collate them as we go through. And we're planning to leave about 10 to 15 minutes to go through questions at the end. And what I will do when we do that is I'll prioritize the questions that seem to come up the most through the chat window. So if everybody's asking, for example, about inflation, I'll ask those questions first. Any questions that we don't get to today in the session, we'd be happy to answer them via phone or email afterwards if you'd like to ask your question. We also have obviously the usual disclaimer, which is at the back of the presentation. Everything that we say today is for educational purposes. Please rely upon your own due diligence before making investment decisions. And also there will be a survey after today's presentation. It will really help us out if you can take a minute or two to complete that. So now that we've got the housekeeping out of the way, I'd like to launch our first poll. In a world where a 70-30 portfolio is likely to struggle, what other investment opportunities are your clients looking at? So we have a few different options here: cash, cryptos, gold, residential property, private debt, or other. So far, private debt is in the lead. I'm surprised, only one person for gold. A few people looking at market neutral as well. Okay, very good. Thanks for answering. So we'll share the results. So as we can see, private debt was the clear winner, residential property coming next, followed by long, short, or market neutral equity strategies. So we'll move on to the second polling question. What are some of the key investment challenges that your clients are facing today? Capital preservation, sustainable growth, inflation hedging, tail risk hedging, income in retirement, or other challenges. We see inflation's in the lead at the moment, as well as growth. They seem to be the number 1 and 2 challenges at the moment. I'll let everybody answer. Okay, I think we've got everybody's response. And we'll share the results. So we can see inflation hedging was the clear winner, followed by trying to find growth in a portfolio, and then capital preservation and tail risk hedging. So thank you for helping us with the poll. This is helpful because it will give us some feedback on which points to perhaps spend a little bit more time on as we go through today's presentation. So with that in mind, I would like to introduce Shane Lee. As I mentioned, Shane is an economist and strategist with Foresight Analytics. He's going to take us through his views of his asset allocation views and where he's seeing the market in 2022. But before we do that, Shane, please tell us a little bit about yourself.
Yeah, thanks, Dan. So good afternoon, everyone. So my background is generally in investment banking and broker research, so mainly on the institutional side. I started out at the RBA a long time ago, spent about 3 years there and ended up at Citigroup. I was there for about 10 years, working in equity research, covering the Australian economy and the Australian equity market. I was at ANZ for a few years doing bond strategy. At a Malaysian bank called CIMB, we had a broking presence in Australia. I was there for 3 years, working as an equity strategist. Last few years, I've been working for myself, working with Jay from Foresight. I'm just trying to develop a strategy type of product, and so I've been involved in financial markets for sort of well over 20 years now. So what I'll do is just sort of go through a couple of the key issues that I think are important for asset allocators at this stage. Firstly, the pandemic. I think these days, as just about everyone's an epidemiologist, we just get hit with the news every day. So everyone will sort of have their view on the pandemic and when it's going to end and what the vaccination rate should be, etc. But one thing's for sure, it's not over. So we've got to keep that in mind. Probably the biggest concern at the moment, though, for investors, I think, is inflation, which sort of leads into the next point as well, which is the business cycle. So inflation generally comes late in the business cycle, and central banks usually will try to front run it by withdrawing stimulus and getting policy back to some sort of neutral level. So this cycle's been a little bit different in that we come out of a recession very quickly in 2020, 2021. We saw a recovery with the pandemic still lingering, but demand relatively strong just based on the stimulus that's been put in place in 2020. And then we had these issues around the supply side of the economy. So what that's done is probably shortened the business cycle relative to what it's been in the past. And we have a couple of indicators that we sort of look at there, and I'll go into those as I get through the presentation. Geopolitics has become a lot more relevant just lately, and I'll sort of mention that. Financial markets tend to sort of observe a lot of this and watch it sort of percolating just in the background, because sometimes they tend to be binomial sort of events. It either happens or it doesn't. So the situation in Ukraine, I'll sort of talk about that and just some of the implications out of that. And then talk about just the asset class valuations, mainly just in equity. So I'll focus on Australia and the US, and I can talk a little bit then about how we build up our TAA framework and what the preferences are. And I'll speak a little bit just about the Aussie dollar.
Very good. So be keen to get your thoughts on the pandemic and where you see things at the moment.
Yeah, thanks, Dan. So basically, globally, we've had this pickup in case numbers just because of the Omicron variant. A lot of countries, the rate of increase has now been matched by the rate of decline. So cases are now dropping quite quickly, and the reason for that is that the vaccination rates are high. So I don't think there's any news there, but we have to sort of think a little bit further down the track and what might happen. And I think just about everyone in the epidemiology world sort of thinks that this is not the last variant, and there will be more variants further down the track and things that we have to deal with. However, I also think that basically we're all becoming a lot more adaptable to the pandemic, and there have been restrictions, and we've sort of adapted to those, and they're becoming smaller and smaller over time, but they're still lingering nonetheless. So and they can sort of backstep, health policy can sort of backstep to address some issues for these variants that come in further down the track. So, we've got to be quite mindful of this. It's not over, it's going to linger in the background. And the way we should think about it is what it actually means for the functioning of services and supply chains. There are some signs that that's now starting to ease a little bit, and I'll just talk about those when I talk about the inflation backdrop. But I think it's important just to realise that this is not the end of the pandemic, because we've got Omicron cases rolling over. There's still a lot further to go, I think.
Do you think we're at a point where governments, from a policy point of view, are going to start treating the pandemic as an endemic rather than a pandemic? Because you're seeing, obviously we're not through the infections yet, as your charts show, but we are starting to see signs of countries rolling back some of the rules and the mandates and the restrictions. UK, for example, Ireland, Denmark, Norway. Do you think that there's going to be an increasing difference between how we handle the pandemic versus cases and hospitalizations and deaths?
Yeah, I think that's right, Dan. I think the way we adapt pretty well as a species, the human race. So I think we're adapting to this as well. So you mentioned the approach that the UK and Denmark have taken recently by just easing restrictions, even though case numbers are high, and I think that's a good example of that. The only sort of issue at the moment is that the vaccination rate in EM is still very low. So that means the risk of variants, etc., is still there. And then when I look at the second largest economy in the world, China, they're still running a zero COVID policy. So there's questions about after the Winter Olympics whether that's sustained or not. But I do think that at some point they'll have to sort of let go of that. And I think from a global perspective that would be a good sign. But at the moment, when you've got one of the major suppliers to other advanced economies around the world running a zero COVID strategy, then that sort of tells you that these issues around supply chains probably haven't really sort of come to an end yet. This is just a couple of charts just showing the vaccination rate. And as I mentioned earlier, places like India, vaccination rates just touch over 40%, Brazil 70%, even Hong Kong 60%. So there's still a way to go. Indonesia sitting at 40%. So you'd like to see those vaccination rates up into the 70s and 80s, like you see in Japan, the UK, and Australia. So inflation is probably the biggest thing that's on investors' minds at the moment. And it is a global issue, as you can see there from those charts, that inflationary pressures have been building in Europe, the US, Japan, China, Australia, the UK, New Zealand for a while now. And central banks, up until probably the end of last year, have been quite happy to say that a lot of these inflationary pressures are due to supply side constraints. And that's certainly been true. But once you start to see inflation sort of affecting the price of labour at a broad sort of level, then you've got a little bit of a problem, because inflation expectations then rise, and then that causes inflation just to sort of feed on itself, and then it can easily get away quite quickly. So that's caused a number of central banks to become concerned. But central banks have already been raising rates globally in response to these inflationary pressures. But I think this year, with the Fed likely to raise rates in March, and then further throughout this year, Australia probably to join in later, along with the ECB, that there's a pretty clear sign that we're starting to live with the virus. There's still these supply side constraints. Some of them look now more permanent probably than what they were at the end of last year, and the central banks have to sort of get about their business of withdrawing some of the stimulus that was put in place during the early days of the pandemic. So far in China, inflation pressures are still reasonably modest, and you can see there in Japan, which has had periods of deflation on and off for the best part of probably about 25 years. The deflation is still quite low, but in the US, that's probably where the inflationary pressures are of most concern. In Europe, again, you still, if you look at CPIX, food and energy, then you have to go back to about 2001 see inflation at such a high level, but in the US, you certainly have to go back a lot further. So what we're seeing at the consumer level probably doesn't reflect what's occurring upstream. So these upstream developments will affect inflation probably 3 to 6 months further down the track. There's actually some good news that's starting to come through, particularly in the shipping rates. So both Harpex and the Baltic Dry, they've both fallen just in the last couple of months. And then we also see in the US that in the manufacturing sector there that delivery times have started to fall and the backlog of new orders has started to fall as well. So that sort of tells you that, at least in the US over the last couple of months, there have been some improvements in the supply chain. And this is broadly across the US, but also in some of the regions as well. So New York and in Philadelphia, similar sort of issues. And if I look at the Richmond Fed survey, other business surveys in the US, they're all sort of telling you the same thing, that we're just starting to see some sort of reduction in pressure on supply chains just over the last couple of months. And we certainly hope this continues, and some of those inflationary pressures probably hitting in the second half of this year start to ease a little bit, and the central banks can back away from raising interest rates. But as I mentioned, part of this inflation story still has a permanent sort of aspect to it. And probably the best example there is when you look at, say, the US labour market and the participation rate and compare that to where it sits in Australia and Japan. In the US, it's still well below where it was pre-pandemic. In Australia, it's bounced back, and in Japan, it's bounced back as well. Europe, similar story to both Australia and Japan. So you've had a bounce back, but in the US, it's only just started in the last months just to tick up, but it is starting to show signs of recovery. And you'd want to see that back around 63% in the US's case, and that would sort of suggest that some of the wage pressures we're seeing there might start to ease. But at the moment, we've still got quite a way to go to get back to that sort of level. Meanwhile, obviously, without that additional labour market capacity coming in, the unemployment rates are low. So in the US, sitting just a touch below 4%. Same in Australia. Europe, you're down at low levels as well. Japan, even in Japan, the unemployment rate started to decline, but not quite yet at pre-pandemic levels. But so I think what investors should really do is look at how that supply of labour is coming onto the market as some kind of a sign about where inflation might go in the next few months, apart from those other indicators that I mentioned on the previous slide.
Thanks, Shane. A few key points stood out to me in your comments that I'd like to just ask you for a bit more detail on.
Yep.
The first point was regarding, you mentioned interest rates possibly going up or already starting to go up with some central banks. Mm-hmm. I know that many of them are also reducing their bond buying programs. That's happening here in Australia, that's happening in the Fed. Roughly, what's the impact of that? If you were to think of it as an interest rate rise, is stopping the bond buying equivalent to, say, a 25 or a 50 basis point interest rate rise, or how would that impact markets, do you think?
Yeah, it's sort of a difficult thing to fully quantify, just because there's so many different factors that sort of drive it. So Australia is probably the best one to look at, because we've just sort of stopped our purchases. Other countries are sort of winding them back. And in the US, it's going to be scaled back fairly quickly as well. I've got to think it's probably worth 25 basis points, but that's purely a bit of a gut feel, because you've got a lot of other sort of things going on as well, particularly with, say, inflation. Yeah, I think maybe 25 bips or somewhere around that area. That was kind of the sense during the financial crisis, that somewhere around that sort of level. And the bond purchase program now is in the US has been quite large, and to that sort of scale.
Okay, and in terms of labour participation, I've heard this. It's been called the Great Resignation. People retiring, and I saw an estimate that a friend sent me from Raymond James in the US that 2.5 million people have retired early.
Yep.
Because obviously COVID's changed their lifestyle, and their 401ks are at all-time highs, thanks to, well, until a couple of weeks ago, they were at all-time highs. So they've just taken the opportunity to retire early. Are we going to see something like that here in Australia, do you think? Is this going to be an issue in terms of demand-led inflation?
Yeah, I think everything you said is right about the US, Dan. In Australia, there's no sort of sense of that at the moment, just purely because the participation rate has bounced back really quickly, and it's sort of back up around those sort of levels that it was pre-pandemic. But yeah, if I was to draw a line there in there, just showing age cohorts, you would see the 50 to 65-year-olds just has not moved at all. The recovery in the participation rate in the US has been generated by the younger cohorts. So as you say, with the savings that's been generated during the pandemic, there's a lot of people that have just decided, no, it's all too hard, I'm going fishing. So.
I think it's amazing that the wage growth numbers in the US are the highest they've been in decades, and yet at the moment, wages are still negative in real terms versus inflation. And as you point out, if that continues for a while, it's going to start to get reflected in inflation expectations. So I think you make a very good point in your presentation that so far a lot of the inflation can be explained by what's been happening on the supply side, and that looks like it's moderating, but we have to watch very carefully what's happening on the demand side, because there are some risks building there too.
That's exactly right. So just the next chart, I'd just like to sort of show this because I think it's important. So the New York Fed estimate the term premium on the 10-year yield in the US. So the 10-year yield is sort of broken up into two parts. One is the short rate expectations, and the other is the term premium, or the compensation that investors get for holding duration. And that's been below zero for quite a while, sort of heading into the pandemic. And it's again just turned negative again, but the 10-year yield has risen. So that sort of tells you that the last few months where we've seen the increase in yields has been mainly due to an increase in short rate expectations. And you can check the Fed Fund futures curve to see that as well. But it's just an important thing, I think, that when we're looking at US Treasuries, they're still at 1.9%, extremely low, just given where inflation is in the US right now. And that term premium is still being squeezed despite all the uncertainty around inflation and the volatility inflation that we've had over the last few months. And it's purely around short rate expectations why the yield curve, why treasuries have backed up as much as they have. Another sort of sign that the bond market's probably not all that worried about the current round of inflation, as we saw a big increase in the break-even rate in the US, but now it looks like it's just sort of peaked out at levels that aren't too consistent with late cycle periods in the past, so around 2.5%. And I think that's sort of a positive sign as well, that yields will probably increase from here. So yields on duration will increase from here, but maybe not all that much, just because that term premium is just so well anchored.
Do you have a sense of at what level does the yield start to bite equity valuations?
I think it's so. If you look at the way the Nasdaq is sort of traded with the valuations there, then that sector of the US market has definitely rolled over, and closer to home, we've seen stocks like CSL under a lot of pressure as well, just putting aside the acquisition that they're making. But so any sort of growth stocks or anything with growth, I think, has been under pressure, just as we've seen yields sort of back up from 1.4 up to 1.9%. So it's about a 50 basis point increase there. So if we're moving up to 2.5%, that is a big negative for growth stocks. There's no doubt about that. But given that the increase has just been driven by short rate expectations, if you think inflation's sort of coming back a little bit and the Fed's not too far behind the curve, then maybe 2.20, somewhere around there is what we might see rates peak at this cycle. This chart, this table just sort of shows you very quickly just what some of the central banks have been doing. So the green highlighted section there is sort of what's sort of priced in at the moment. So the Fed's priced to go next month, and then so 3 for the year so far. The sort of probabilities that probably sits a little bit higher. As you can see, Brazil, traditionally an EM, inflation is a pretty big issue, and they've been pretty quick to respond to inflationary pressures in Brazil. New Zealand and South Korea, and then the UK towards the end of the last year all responded to the inflationary pressures that we've seen. But some of those central banks now, the expectations, as you can see there, are that they've got a little bit more work to do at this stage, but maybe in the first half of the year that they may sort of stop for a while and just see how things play out. I think that seems to be the market sort of view there, but the 4 central banks that are off to the right there, I think the message is there that they're the central banks that have been saying that a lot of the inflationary pressures are going to be transitory, and they'll wait to see inflation rise before they start raising rates. And the market said, well, okay, that's fine, but now you've got to get on your bike because inflation's actually started to increase a lot more on the signs that it'll continue if you don't do anything. The important thing about inflation is that it usually occurs late in the business cycle. So these are the barometers that we use to sort of gauge where we are in the business cycle. So one is the yield curve. It has all these criticisms from time to time, and how global savings has pushed down yields and it gets affected, etc. But it's tended to work pretty well over the last sort of 40 odd years in predicting the big equity market drawdowns that come with recessions. So you can see there that the curve, it's actually around 62 points now. It's sort of steepened a little bit since I updated these charts. So once it gets back to around about 0, you've usually got a large equity market drawdown within 12 months. But it's not the only indicator that we look at. And usually when you get an inverted curve, you usually have a fairly sharp increase in the 2-year yield just preceding that as well. And you can see there that at the moment, the 2-year yield is still fairly low, and it's only just started to rise in the last couple of months. And credit spreads as well, that's again something you would normally sort of see in the lead up to a recession. That wasn't the case in the pandemic, which is not really a surprise, but nonetheless, credit spreads at the moment, they've moved up a little bit, but they're still sort of reasonably tight. So I just don't think we've got the precondition there at the moment for a recessionary type of equity market drawdown. But nonetheless, if we look at, say, indicators on the yield curve, and you can pick that out of some of the business cycles, the business surveys in the US, the Philly Fed expectations, less current conditions, that tends to lead the yield curve by a few quarters, and that's telling you that the curve's going to continue to flatten, but it's still a fair way off being flat or completely flat or inverted. And again, the similar story there with the New York Fed. Again, expectations, less current conditions. It's telling you that the yield curve is still going to flatten. But as I said, this usually it gets to flat or inverted, and that's still around about 12 months before you start to see signs of an equity market drawdown. I just wanted to mention geopolitics because it's sort of come out of left field a little bit towards the end of last year. But people in financial markets tend to sort of look at geopolitics as something that's sort of simmering in the background, but don't really worry about it. And I just want to sort of highlight a couple of things that the situation in Russia can potentially derail markets. There is absolutely no doubt about that. The price of oil has risen already. And Russia supplies 25% of Europe's oil and 40% of its gas. So there's a lot at stake. I think there's also a lot at stake geopolitically as well, in that Russia's trying to sort of grow itself geopolitically to put itself alongside the US and China as some of the bigger global powers. I don't think that ambition's gone away, but the risk, I think, out of all this is that there's a war, and that the Russian troop build up around the border to the north, to the east, and to the south of Ukraine would sort of suggest that. And there's certainly a risk over the next few weeks that may occur. So I just want to put it out there as something that will cause volatility for markets if these conditions start to escalate. So obviously it'd be positive for oil, positive for gas, positive for gold, would be a negative for bonds and a negative for equities. So makes it a very hard place to hide if things do escalate. And it is sort of linked to that second geopolitical issue as well, which is China's expansion in the Pacific. Taiwan is the tipping point. I think most people who sort of follow geopolitics acknowledge that. And the thing is that both of these two issues are somehow linked, because I think that Xi Jinping would see the developments in Russia, and particularly the way that the US negotiate with Russia in the event of an invasion. How they respond to that is going to be seen as a template as to how the US might respond to China expanding or invading Taiwan. So there's a lot at stake with all of this, and I just think investors should be, this is something that they really need to watch just over the next couple of weeks and over the next few months throughout as this year goes on.
It always amazes me how good markets are at sniffing these things out. Like you mentioned, for example, the rise in the oil price because of the tensions in the Ukraine. One thing I've noticed with the stocks that I work with is that many of the fertilizer stocks have been performing very, very strongly. Okay. And after digging a little bit into it, I found that one of the key ingredients in making fertilizer actually comes from Ukraine, from that area. And they're one of the largest suppliers. So it's interesting to see how those stocks have moved up a lot, probably reflecting the fact that there's some question marks about whether or not they can get the supply of this key fertilizer ingredient out of the country. But just before we move on, I want to remind everybody to please keep the questions coming. Type them into the Q&A and we'll save them for the end. On the business cycle, I couldn't help but think about something that I'd heard in a podcast recently that was said by Naval Ravikant. If you don't know Naval, he's an extremely intelligent VC investor. And one of the things that he said in reference to the pandemic is that it has accelerated everything. For example, it's definitely accelerated working from home, the use of technology, shopping online, all of these trends that were already going to be big anyway. It's brought a lot of that forward. And it seems from your comments that it's also brought the business cycle forward, that the typical sort of 10-year cycle now looks like it's going to be done in 3 years. Do you think it's a fair sort of comment?
Yeah, I think so, Dan. So we haven't really had such disruption to the supply side of the economy since the 1970s, probably, when we had surge in oil prices, and so I think that's right. A lot of the cycles that we've had over the last few years, you've always had sort of strong demand, and then just your output gaps opened up, and then central banks have sort of gone about the business of closing it and meeting their inflation targets. And there's been an underlying build-up of pressures in other areas. Like in 2001, we had a large build-up in inventories, particularly in the tech area, and then the GFC, obviously. So there are sort of underlying issues, but I think most cycles have generally had those sort of trade-offs between the output gap and inflation and what the central banks do as part of it. This one is entirely different. You've had big disruptions to services, which have been pretty much thrown under the carpet, and then you've had strong growth in demand for goods, and then that's put pressure on supply chains. So it's been quite unique in that way, but the principles that central banks are working to are still quite the same in that way. In that once demand looks like it's going to be sustainably picking up, and you've got this open output gap, and that needs to close, then they have to get about the business side. So I don't think that's changed, but you're right. It's certainly shortened the cycle to what we've had in the past.
And In terms of the yield curve, I picked up a very important nuance in your comments that it's not the tightening per se that derails markets, but the tightening almost starts the clock
Yep.
on when a recession is more likely. And I've seen similar work on rate rises. It's typically not the first rate rise that derails the equity market, but sort of the second or the third,
Yep.
particularly if the third is a surprise rise that actually causes the market to come under pressure. So that's important to remember. And I think it's important to point out as well that your comments are giving investors a framework for the risks to think about. So on the inflation side, the key items are the demand-driven stuff. So what's happening with participation rate and wages and inflation expectations amongst consumers. And in terms of the economy, the key guideposts to look at are the yield curve, the output gap, and where we are there. So I think this is very helpful to be able to give people red flags that they can tick off as we go along, if these things happen, sort of an idea of what to look out for.
I might just sort of skip through a little bit, just in the interest of time, and I'll just pull up this table at the end. So what we do is we try to pull all this together into a strategy, and we run models for TAA purposes. So that pulls together preferences, and it's a scorecard type of system. So we sort of crunch our numbers for equities around valuations, earnings, and also technicals, and all those three areas are all broken up into different types of ways of coming up with valuations. And we run a score out of between 0 and 10, and then come up with a score. And then in developing a strategy, we sort of massage those numbers down a little bit using just our experience and our sort of feel for markets to come up with some preferences. And that's sort of how they sit at the end of last year. So we had a preference for growth assets over defensive assets. And the reason for that is because, we're still in the, mid to late part of the cycle, but we're certainly nowhere near the end. We've still got a few years to go, as you mentioned, Dan. And our preference in equities was for the ASX 200. That's sort of changed a little bit just in the last month. So the US would probably sort of move up a little bit. Europe would move up a little bit, and the Nikkei would probably move down a little bit. Australia would move down. But at the end of last year, when we released our outlook for 2022, then Australia looked the best market based on just valuation, and also the chances that earnings would exceed what the market was expecting. In defensive assets, our preference was global property, and then second was Australian government bonds, but there's a clear underweight in those assets as well. So we did expect yields to rise, but getting up around sort of 2% or somewhere, there's probably not that much further to go, we didn't think. Credit spreads are very tight. So credit was down the bottom of our preferred assets, and along with cash. The only reason you hold cash is if you can't hold anything else and you think the world's about to end. That's kind of where our preferences sort of sat at the end of last year. As I said, the equity order would probably change a little bit, but in fixed income, it's probably sort of roughly the same.
So in terms of this model, I believe the equity weightings are based off valuation, earnings outlook, and technical factors. Is that correct?
Yeah, that's right.
And the defensives in terms of some economic indicators that have a bit of a track record in forecasting future rates, correct?
That's right. Yeah. So in fixed income, we look at central bank policy rates versus expectations, inflation, and also lead growth indicators as well, and just sort of where they're tracking versus their average or potential. So if they're tracking above potential, that's sort of a negative for bonds.
We were talking about this chart yesterday, and we sort of agreed that we could summarize it as your views are in favor of growth assets with some caveats. And the caveats are, as we learned on the way through, the need to pay attention to whether inflation is more permanent than we we might have thought. Also, the risk that we could be closer to being late cycle than in a normal business cycle. And what this possibly means is that markets will have higher volatility and possibly be more correction prone.
That's right. That's exactly right. I'll just talk just very briefly just about the Aussie dollar. I think sort of in the short term to medium term, there's probably downward pressure on it at the moment, particularly if the geopolitical situation in Russia and the Ukraine escalates, then that would be a negative for the Aussie dollar. There's no doubt about that. In terms of the interest rate differential, clearly the Fed is going to start raising rates earlier than the RBA, which would keep sort of upward pressure on the US dollar and downward pressure on the Aussie. And then, China is trying to support its housing market at the moment. It tightened restrictions about a year or two ago, and still you're starting to see some weakness, but the iron ore prices just started to rally a little bit. I still think that, with Chinese growth still on a slowdown trajectory over sort of the next 3 to 6 months, then there'd be sort of downward pressure on the Aussie dollar as a result of that through the iron ore price. So it's hard to sort of see the iron ore price sort of ticking up much above sort of 150 or something like that. So I think just in the short term, downward pressure, medium term sort of upward pressure as we sort of go. The pandemic's sort of right in the rear vision mirror. Inflation's in the rear vision mirror, but still that's probably a fair way to go yet before we get there.
Very good.
And this is sort of a chart just to show that the Aussie dollar just over the last few months has just been sort of hitting some peaks in a downward trajectory. Just sort of highlighting the downward pressure that's sort of on the Aussie dollar at the moment.
Yes, it does seem to be at the moment range bound between sort of 74 and 70 cents, doesn't it?
Yeah.
Okay, I think we've covered the main points from today's presentation. We'll open it up to questions. We have a few questions in the Q&A section. Please type them in as we're going along. So our first question is the market underestimating future inflation levels, and therefore some significant adjustment in bond rates is required as everyone realizes that there is significant structural inflation?
So as I mentioned, I think there are signs that inflationary pressures are just starting to ease. So it'll take a while to affect the CPI, but I think that's a positive development. But I still think there's a component that is sort of permanent. In other words, around particularly, say, the US labour market and the issue around participation in age and older cohorts. So there's some sort of permanency there. So, and the central banks are sort of weighing this sort of thing up at the moment. In terms of bond yields, though, if I just sort of look at how I sort of disentangled the US 10-year yield and that the term premium is still negative, that sort of tells you that there's still a lot of people out there that are happy to hold duration, if you like, longer term, and don't need any compensation for it at all. In fact, they're quite willing to pay for it. But at the same time, the bond market expects short rates to rise. So I don't think it has thrown the towel out the door. It believes that the central banks can sort of get about this business and slow inflation. And there's other indicators on, the break-even rate in the US as well, which is telling you that. So I think what we should expect is probably short rates to rise this year, definitely, but not in a big way, and certainly not in a way that we saw, say, in the mid-1990s when inflation was sort of getting away on the central banks, and a rate rise had to happen. It had to happen in the month after that, and the month after that. I don't think we're anywhere near that yet, but we still should expect short rates to rise and probably the long end to drift up a bit further as well.
Okay, questions are coming in thick and fast now. So we've got another one. Within shares, what is the preferred asset allocation? You're thinking of any tilts to energy or infrastructure or any style tilts?
Yeah, so in terms of style, I think cyclicals, just given the issues around rising rates with growth and then the discount rate that's applied to those stocks. We've already seen a downturn in tech or a correction in tech that's sort of been reversed a little bit over the last sort of week or so. But I can't believe if you think that longer rates are going to keep rising, and particularly if you think that, so the central banks have got a lot of work to do, then you would not hold growth. But still, the cyclical story is sort of still there. It's getting late cycle. However, there's still cyclical earnings to be had, and it comes back to even stock specific sort of investing rather than sort of even at the sector level. If we look at the sector level, short term, energy, gold, I think there's pretty positive risk return sort of reward trade-offs there. Around the banks, steeper yield curve, usually good for the banks, so flattening out, generally not that good. And then with the resources stocks, so the bulks, for example, that really depends on your sort of view on China and particularly the property market there, and whatever supply constraints are still lingering in Brazil and places like that. So, and then when you get into the industrial space, again, that's sort of more about the sort of broader economy. And if you've got inflationary pressures easing at the moment, I think that's a positive sign around the cost base, because you know that the recovery is still going to be here for a few years.
It's interesting in the stock work that I do for the hedge fund. I often screen for high momentum names. And at the moment, the industries that are at the top in the US are anything oil. So oil exploration, oil transport, oil services, coal. Coal is actually doing very well. Fertilizer stocks, shipping, and now financials are starting to move up the list as well. Home builders were doing better, but they've sort of backed off a bit. They're sort of still somewhere in sort of the top 20, but they're the industries that are doing the best. On the growth side, we are seeing a little bit of a bounce back in some of the growth names. And one of the things that I look at is the ratio of the performance between growth and value. It got extremely extended in terms of how far the swing to value went over the last couple of weeks. It got to levels that it had never gotten to before, even bigger than post GFC. So it's not surprising to see growth having a little bit of a bounce back now, because a lot of these growth names got really, really oversold. In terms of the growth names, what's been a really tricky thing about the stock market over the last year or so is that a lot of the growth names peaked in February, and they peaked well ahead of the market. And what you've seen has been a steady deterioration in market breadth ever since. So a lot of the growth stocks have actually suffered really, really severe bear markets already. There's been a stealth correction happening. And if you want to see it, just look up a chart of the ARK ETF, look up a chart of the SPAC ETF, look up a chart of the QQQJ, which is the NASDAQ Next Generation 100. And you see the pain that a lot of stocks have endured. Pretty much since February, they've been on a downward trajectory, and obviously it's accelerated in the last couple of months. So it's been interesting to watch that. The value sectors look good, but they are quite extended, and growth has been quite beaten up. So it's probably not going to be a one-way move, even if value does better. There'll probably be a lot of rotation and volatility to come. We have another question about the S&P 500 and its level of overvaluation. What type of downside do you see if rates go back to their cyclical peak?
So it sort of depends. So it sort of depends on what happens to the economy in the throes of all that. If inflation's still lingering and the central bank chasing inflation is going to cause the downturn, then most likely that will be a recession, and that will mean a 30 to 40% equity drawdown. But if inflation sort of eases a little bit, and the RB and the Fed can sort of pause after raising rates for a while, then there's still more in the stock market cycle. So in that case, you can get these 10% sort of corrections along the way, and then the market will rally back. It's always difficult to time these sort of things, but what you really want to avoid is that end cycle type of a correction of 30 to 40%, like we see as a precursor to a recession. So yeah, that's the way I would sort of think about it. Yeah, obviously valuations are stretched, so that means your starting point leading into one of these downturns isn't as good as what it could be. But that's not unusual sort of late in the cycle as well, and that's why you get such big type of corrections before recessions. So I just think what the Fed does over the next few months in response to inflationary pressures is the key to all of that.
Yeah, I've looked at the history of bear markets in and out of recession, and the rule of thumb seems to be that a bear market with a recession is about twice as severe as a bear market without. So if you look at the US, the average bear market outside of a recession is about a 20% peak to trough decline. It gets closer to 40% on average in a recession. So there's a big difference in terms of risk for investors if you have a correction like we're having now, that arguably we're not in a recession, as opposed to a correction when the indicators that you mentioned, such as the yield curve and the output gap, are suggesting that we might be headed for a recession. So we've got some more questions, which is great. Don't real yields need to return to being positive?
Yeah, they do. So the question is why the real yield is negative at the moment, and that's because inflation's running ahead of the policy rate. So in other words, real yields can become positive if inflation starts to ease a little bit, rather than the other way around, with policy rates sort of rising faster than inflation. So and I think what I mentioned first is there's a good likelihood that will happen. So okay, yep, they're negative at the moment, but I think they can sort of go back to being somewhere sort of slightly positive, around about zero, without being completely disruptive to markets, just purely because inflation can start to ease.
Okay, we have a question about differing investment time horizons, I think. So the question is, are any of your technical signals in conflict with your fundamental analysis, i.e. do they suggest a different direction or timing?
That's a pretty good question. So the way we sort of use the technical signals is to provide some sort of a short-term sort of view, but fundamentally, I'm a fundamental analyst, so I put a lot more weight just on the fundamentals around valuations and earnings, in particular for stocks, and inflation and policy rates, and growth for fixed income. So I put a lot more weight on that, and the technical indicators are really just to give you a sign whether momentum has sort of become stretched, and if that sort of lines up with what you're seeing around valuations being stretched, and that tells you that there's a good chance of a correction coming up. So the technical indicators are really useful, sort of mid-cycle and where you've got volatility. There's no doubt about that. But at the start of the cycle and end cycle, they're probably less useful. So that's the way I sort of use the technicals with the fundamentals.
Mm-hmm. I can speak a little bit about what I'm seeing in my portfolio. So I have a intermediate term valuation model. So by intermediate term, what I mean is it should trigger maybe 2 or 3 times a year, and I use it more as a guide to rebalancing. It is value-based, but it's not long-term value-based, because I never saw the point in creating a model that would tell you something's over or undervalued for 2 or 3 years at a time, like some fund managers do. That model actually triggered a buy signal on the 31st of January. So if you're taking an intermediate horizon, the sell-off in the equity market, the US equity market, presented an attractive entry point. Having said that, the technical information that I use, the indicators and the stocks in general that I'm looking at, and I'm looking at sort of 200 to 300 stocks a day in detail, they're still looking quite poor. And the information that's coming from that is quite mixed. So a lot of stocks took on a lot of damage in this sell-off. The fall in the index really hides what's happened in some stocks. Just look at Facebook, and look at that Snap, which fell in sympathy with this Facebook, and then when its results were good, rallied incredibly. So there's actually been a lot of damage to a lot of stocks under the surface, and a lot of stocks are still, it's not clear that they're in recovery mode yet. And the index is somewhat hiding that because you've had great results from Amazon and Apple. So in terms of technicals, I would call the picture mixed, quite mixed. And in terms of the fund that I manage, I'm still on fairly high levels of cash. We have another question on supply chains. If there are expectations that supply issues will be longer due to low vaccinations in EM countries, are supply chains increasingly likely to be brought closer to home? And could we expect greater automation if this shift was to happen?
That's a very good question. I think that it takes time to adjust supply chains, and there has been adjustments over the last couple of years, and particularly probably the last 12 months, which makes supply chains more resilient, if you like, to disruptive sort of issues around COVID, etc. So I think a lot has been done in that particular area. But nonetheless, if you look at the big picture around this, different parts of Asia and China in particular, being a supplier of goods into the US and into Europe, other parts of the global economy, that it's very hard to sort of unpick all of that, because the supply chains of, there's just such a precedent there, and the investment's been put in place, etc. So I think in probably certain industries that's the case, but I think we just have to rely on sorting out the issues with COVID around quarantine periods, etc., and rules around being close contacts, all that sort of stuff. As the pandemic gets further down the track, we tend to adapt a lot more to it. I think we've seen evidence of that over the last couple of years, and I think that will be sort of the main part of the process. But I'm sure there's some companies that will have just taken out some insurance, particularly just given the geopolitical issues between China and the US. If they're willing to take a longer term strategic sort of view on that, then they've probably already done something about it, and the pandemic just accelerated that process up. But I dare say some of that planning was probably done 2 or 3 years ago.
Thank you, Shane. I've just noticed on the clock it's just coming up to 3 o'clock, and we promised to have you out of here by 3 o'clock. So I think I'm just getting a comment here, Shane, if you can move forward to one of your slides on resources. I think it is, just so that we can, yes, that's right. The resources that we have put together for our listeners. So we can just quickly talk about that. That's it.
Yep, sure.
Yep, here we go. So you can see here, and this will be in the presentation that you receive, links to Shane's 2 papers. So his paper on inflation and his 2022 outlook. And also there's some links to the Foresight Active Advantage podcast series. So there's been a couple of full episodes uploaded to a podcasting platform, Buzzsprout, and also YouTube. And on YouTube, you can also find clips on specific topics. There's an excellent clip where I'm chatting with Gavin Davies. He's the co-founder and chairman of Fulcrum Asset Management, a global macro hedge fund. And before that, he was the chief global economist of Goldman Sachs. And he also worked for the UK government in the 70s when they had to fight inflation. And it's a really interesting conversation because he actually highlights many of the same points that Shane brought out in terms of what to look for on the demand side, if in fact inflation turns out to be more permanent than we thought. So I encourage you to check the podcast in audio and video formats out on the podcast channels. So with that, I would like to thank you, our audience, for joining us today. Thank you very much. And thank you, of course, to Shane for all your hard work in putting together today's presentation.
Thanks, Dan.
Thank you, everybody. Enjoy your day.